Okay, today was quite a volatile trading session, and that gives us things to consider, both short and longer term views to dissect and analyze, and important points to address. So we closed off the lows. It wasn't a super volatile day in terms of the actual chart once it relaxed, but we started up over 1%. We got up to about 1.5%. And then we got to a point where we were down 1%. That is a very large intraday move on what seemed to be virtually no catalyst. There was no major event that happened in the middle of the day to prompt that. There was what looked like some possible short covering first thing in the morning. People saying, oh, I got some gains. Let me lock these in. Things with Bitcoin rallying. And then it just stopped. It just stopped. And that, I think, gives us some clues on what's going on out there. There's just simply less demand for stocks. And we've seen it this year, and we're going to continue to see it, that as yields go up, the return offered by yields becomes more attractive, and stocks don't really do anything different. But people's decisions around stocks fundamentally as a thing you can metaphorically hold. But people's decisions get weighted one way more versus the other when yields change. When yields go up, people are going to start buying some bonds because their minimum return threshold on the risk-free rate has been met, and they decide it's time for me to make that purchase and just sit back, relax, and collect that return, particularly older people. We know the baby boomer generation is quite large. They're certainly in this camp that wants to do that. So there are people out there buying bonds, but there are also a lot of people selling bonds because the Fed's getting hawkish. And a lot of people want to talk about Evans this morning, saying, oh, maybe we should have a pause between the meetings. Well, this is a single guy. In addition to Evans, we heard from Bullard and Kashkari. Bullard saying more rate hikes are going to happen rather quickly, et cetera, et cetera, et cetera. Kashkari saying the market is finally beginning to reflect what the Fed's going to do, what they got to do to tame inflation, and that he doesn't take a look at the stock market. Okay? Note this. He doesn't take a look at the stock market. So for the bulls, banking on a Fed pivot and or banking on a Fed put, they're SOL. They're SOL. It's not going to happen, okay? Rates are going to go up more. The Fed is saying so, and that's not so good for stocks. The stock market is probably going to go down more. However, we are closer, in my opinion, we'll see what happens, but we are closer, in my opinion, to the bottom than the top. Here's why. A lot of this move is being driven by yields. It's constraining the economy. It's making bonds more attractive versus stocks. And neither of those are good forces for stocks. Yields are the more strong of those two forces. We saw it in 2018 when the Fed was hiking. That had a dramatic effect on the market, but the economy was still strong. It didn't weaken. And then once the Fed stopped doing that, we saw a rather rapid recovery in the market. The economy didn't turn around on a dime. The Fed pivoted. Bond yields have gone from less than 1% on the 10-year to just on the verge of 4%. The Fed wants to get rates to 4% minimum, but they're signaling 4.5%. So we've got some more to go. This last move from 3.5 to 4% in the 10-year has been very painful for stocks, but I don't think the next 0.5% is going to be so painful. I mean, it might go down another 10%. If you're asking me what my low-end target is, if you want me to put a number on it, I'm not saying it's going to be right, but if you want me to put a number, and I'm not going to put a number, I'm going to put a range because it's not going to be that number, 3,250 to 3,300. That is my range. Just about 10% more decline. I think we can get there in the next month or so. And once we're in that range, there will be stocks to buy. I'm not saying it's a dramatic opportunity. I'm not saying we hit that level and then face ripper rally, okay? Here's my projection once we get to that bottom. The market is not going to do anything dramatic. It's going to chop around. There's going to be little bits and spurts of moves up and moves down, and we're just going to chop around in that low to mid 3,000 range. And mid, I'm very hesitant to say. I think it would be lower mid. I just think we're just going to churn around in there for at least 6 months. And once the Fed begins to signal that, okay, not only has inflation peaked, not only has inflation come down, but we now no longer view threats to it rising. Let's analyze what the Fed said yesterday. Loretta Mester. She mentioned something we talked about on this video, not because she watched this video, of course, but because we just, we're looking at the truth and we're seeing what the Fed's seeing, I guess, that energy prices might go back up. That is a threat to inflation. And if energy prices go back up, the Fed's job ain't done. We're seeing that today. We're seeing oil prices up. We're seeing Nord Stream 2 get blown up. We're seeing coal prices rising. We're seeing the gas prices rising. We have to let the energy situation normalize. It is far from that. And because it's far from that, as we talked about in yesterday's video, we're long the energy sector. This is our most heavily weighted long in stock sector. Everything else is very small, very light. We've just got a little bit of it because we don't want to miss out if some piece of news comes out that sends a stock up 30%. That's it. That's all we have it for. And it's a smaller than normal position, smaller than it was a year ago. And until we get to that lower end of the range, that 3,250 to 3,300 range, we're not really going to be doing a whole lot in those stocks. Today, pre-market, I'd buy a nibble because I don't know if this rally is going to last a couple days or not. And I was wrong on that, and that's okay. We're still positioned properly, but we got to hedge in both directions from time to time. So, ultimately, not convinced by the market. Won't be surprised if we get a bounce. I'm ready for it. As I said, I think we've done most of the damage so far. I think we're closer to the bottom than the top. And we've had a dramatic decline here. I don't think we're going to have the same kind of slope that we've had for the last month for the next month. It's possible. The market might have a strong consensus and understanding that that's where the market needs to go with yields, and it should be clear as day that yields are going to around 4.5%. And the market could make that move so quickly. But I have decided that probabilities, positioning, choosing not to be too greedy, have forced me to manage the portfolio in a way that it's cash and energy and very much skewed risk-reward downside plays that we're still holding. Things like Tesla, short via stock and options, Apple, short via stock, TQQQ, short via stock. We no longer have the big, huge SPY put options that we used to have. We've collected those gains. Maybe we're going to leave some on the table, but you have to do that from time to time. Not the context of this video, but sometimes you got to ring the register. That's it. It's great to see something on a chart. It's great to see, numbers in there. But if you don't ring the register, what matters? You can't barter with your stocks. I mean, you can, but you're getting out of them if you're bartering with your stocks. So you have to get out of them from time to time. We've decided to do that. That's it. In some of the options. Not because we don't think the market's going to go down, but because they're options, they've got a time. We've kind of given our analysis on the time frames that we're looking at here. We've seen the move. We've seen a part of the move, and it's been very steep and very strong. It can continue at that level. We're not sure. We might see a bounce. Nonetheless, because our certainty and our risk reward skew has changed. We have realized the gains. So that's today's video. We're going to see what happens tomorrow. We'll see if anything new comes that we need to manually adjust for. That's today's video. And until next time, peace out.